But really, I'm not the star tonight. These people are the star. Well, these people are the star tonight. So what I wanted to do before we break for dinner, I wanted to give you something interesting about each one of them. Something that you could talk to them if you're waiting in the salad line. And I'm going to start with Brad. I'm going to ask Brad to tell us one of his best stories about angel investing, and then something completely irrelevant that you'd love to talk about over dinner. Brad.
I think that probably one of the most interesting things in angel investing that's happened to me is to be surprised how companies will start with the essence of an idea and they come up with an investable plan, but it seems like 6 months, a year later, they learn so much more about the company than they did before, and that they would not have known except by engaging the market. And so if you want to ask me about that, that would be good to talk about. And something completely unrelated?
Absolutely.
Okay, maybe you can ask me who's the most famous person I had breakfast with.
Oh, I want to know that. Okay, you know what? That's a great example. Bryce, can you give us a great example that we can ask you over lunch and then tell us a story about angel investing?
Most famous person I had for breakfast? I don't think I'd have a great answer for that. For me, the question, actually, I need to learn from you guys. So I'm traveling to Turkey in May, and I've never been there, and I'd like to, if anyone's been to Turkey and give me some good insights, I'd love them. Good. Story about angel. So I'm an entrepreneur myself and an operator as well as an investor, and I love the build. That's what drives myself and my business partners at the Global Life Wind side and also on the investing side. And it's the thrill of often not the friends and family round, although we've done many of those ourselves, but coming in kind of just after, as Sean showed on his slide, and really seeing that then take off into a concept that becomes at times globally impacting, and then ultimately the satisfaction of the exit. That whole life cycle is thrilling. You know, hiring people, fostering jobs, driving the economy. Those people then spanning their own networks, and all of the spin-off effects of being involved in those early stages and taking those kinds of risks. That's what I love.
Great, we love that you're so open to share it. Derek, you exited a number of years ago and you've become very active in the angel community. What can you share with us about angel investing today that's different than you thought?
I guess for me, at Red Flag Deals, we actually didn't take on any angel investing dollars or any outside investment. So I'm coming at it from a very different perspective in a sense. You know, people started approaching me about potential investments in a space where, you know, I basically had very little visibility. And so I've tried to certainly learn over time. And I think accelerators, for instance, are, you know, a great place, in my opinion, you know, first and foremost, to learn. So I think one of the really interesting developments is the rise of these accelerators, and in some ways, you know, it certainly helps people get to market that otherwise wouldn't be able to make it. Maybe they don't have complete skill sets. So this is a great resource. And so, you know, what I think is really interesting there is I feel like this has almost become a little bit of an alternative to people going to university, for instance. It's a different path towards education. It's education where somebody can actually pay you to go and pursue something that could actually ultimately have a return versus you paying university institution, Sean, to go and work. So I think that's actually a really interesting development, and it's something that I never thought about from an investing perspective before. It's just a lot easier to get up and running versus even when I started. So I would certainly say start young and just give yourself lots of opportunities down the road.
And Derek, one thing that you want to be asked about over dinner?
I mean, I would love to hear you know, what projects you guys are working on. You can ask me about what I'm doing as well, but more so I'd love to hear how I can help you guys.
Tricia, the floor is yours.
Actually, I'm going to take a little bit of an exception with Sean, and the reason I'm going to do that is there's ICT and then there's the rest of angel investing, and they can be very different. I tend to focus a lot on medical technology, and there are significant ISO quality control and regulatory hurdles to get products to market. So from that point of view, I would say that not all angel investors are mini VCs, and that grocery stores and dry cleaners and various things can actually be very, very successful. And then it's good to take an international view, because a lot of things that are good in other countries can be imported here and vice versa. Recently, we've been working with quite a lot of international companies. But speaking about the group, when GTAN, the Golden Triangle Network, did a survey of their members as to why they wanted to invest, the top reason that came back was they wanted to give back to their communities. So from that point of view, a lot of people are in angel investments because they've been successful. A lot of, I think one of the successes of the NAO Ontario is that we have almost 700 members, and it's 12 groups around, and they have their roots in the communities, as compared to Ange Quebec, which has 78 members. So, you know, you can be a mini VC, or you can contribute to your community. And a lot of people are in it because they get bored playing golf. They loved building a business, and they want to help other people do that. They want to be involved. And they're not necessarily involved or planning to go to work for running a Bell Canada fund. So I think there are different ways of approaching these things.
Mr. Buckley?
So I'll start with the interesting fact over dinner. So how did I help youth in Canada today? And to lead into when Sean was speaking about those ugly bankers, well, I was one of them for 32 years. And I had the great fortune of leaving right between the debacles of Bear Stearns and the bankruptcy of Lehman Brothers in May of '08, which some people said was that luck, or was that perfect timing? And I said, whichever it was a good thing. So fast forward to several months later, I was sitting on an airplane going to the East Coast, and I picked up a magazine that talked about angel investment. And really, at that point in time, I didn't have much idea about it. And a woman had wrote a article on angel investing, and I offered to buy her breakfast. And it was in that fall of that year that the National Angel Capital Association had their annual conference in Halifax, and you didn't have to ask me twice to go. So basically, fast forward, I've been engaged in the space for the last 3 years, and to me it's about engagement. Whenever somebody asks me what's the difference between the VCs and the angels, I said, I personally spend 85% of my time on 5% of my portfolio. Those who are familiar with portfolio management, you know, basically this asset class represents about 5 to 8% of the portfolio, and I spend 85% of my time in that space. So what I'm really saying is this gets an inordinate amount of my time instead of doing things like golfing, sailing the world, etc. So therefore, there is an innate interest, and the value that, my desire for the involvement is the engagement and the difference that you can bring as far as businesses, etc. are concerned. So most of my colleagues at Maple Leaf Angels are of similar bent and come at it a little differently, but generally they are looking for the engagement. So we like it when we have entrepreneurs that come and say, we really don't want you, well, they don't say we really don't want your money, but they really say, if you decide not to invest, I would like your help. That is where the perfect place for the average angel is, because they are looking to make a difference in the innovation space.
This is how it's going to work. If you have a question, just raise your hand. I know it's not school. That'll give our spry colleague a chance to run a mic to you. Because we're running this through the web and being recorded, we have to make sure we capture your question as well. If you don't have enough questions, I brought an entire list, so feel free to jump in at any point. I'm going to open the questions with something that people don't talk enough about. The best way to meet an angel. So do you put an ad in the Toronto Star, looking for love, long walks on the beach, software company? Do you call you up out of the blue? Do I go through your angel group? What is the best way to deal with you? Let's start with Derek.
I mean, traditionally, it's going to be through, sorry, let me turn on the mic. Thank you. Traditionally, it's going to be through a referral. So if it's somebody that I've worked with in the past or invested in the past, and they said, you know, you should look at this startup, this company, then that holds a lot of weight. And I think typically that's just the most common method. So that means you have to do a lot of networking. I think what's changing, of course, is in the era of an angel list and LinkedIn. I get pinged all the time because I have profiles there to say, are you interested in looking at this? And I mean, I'll certainly look, and if the opportunity is compelling enough, then we can sort of take the next step. But the easiest and highest chance of success is probably still ultimately through a referral, but that is not to say you should not try using some of these other channels, because I certainly know people that have raised money through AngelList from people that they otherwise had no introduction or any knowledge of in the past.
Bryce, do you agree a referral is the best? And if so, why are referrals the best?
Yeah, so for us, on our side of investing, referral for sure is number one. What we have found, what we learned is you have to be careful with referral though, and not necessarily rely blanket on the due diligence of the referrer. That's been a lesson learned over a couple of deals. But what I will say is that generally, I mean, we have all of us on this panel will have trusted networks of people we've either co-invested with in the past, had success, or people that we trust for other reasons, bankers and advisors and so on. And that's phase one. For us, point two in terms of priority would be, we've co-invested with the Accelerator Fund at Mars a few times. So Derek made some points about incubation and acceleration. We love that. We've been to some venture lab pitches. In fact, something I was going to mention to you around a Ryerson deal, I think we saw at Venture Lab. That you tweet me on that when you put that up. So we love the accelerators. In fact, we sponsor, Wind and Global Life sponsor the Mars Digital Common, and we're investors in the Jolt Fund as well. So we love all of that. Cold inbound is a very rare thing for us to ultimately close on. We'll generally take the email, we'll look at it. There have been, in rare instances, an investment made that way. I think a far better way to get noticed is to get out to an event like this, which is a little bit better than cold, because you warm up very quickly when you see the guys and talk to them directly.
And I think that the audience really needs to listen. Trusted advisors. That's not the guy who offers to take you to meet 10 people and take 10%. Trusted advisors are the Deloitte & Touche who manage these people's wealth, who have a long-term relationship with them, people who they're going to yell at if it's yet another ridiculous deal. And here's why. On 5 seasons in Dragon's Den, I must have met 10,000 companies. Not one of them said, we have a crappy idea. By definition, you love your own plan. But therefore, by definition, the people listening to 1,000 plans have to discount you. You're not going to come and pitch Bryce on a lukewarm idea with a crappy implementation. So everyone pitches the very best deal. So it's the third parties that allow us to see through the entrepreneurial enthusiasm. Brad, what's your experience been with introduction?
I guess the point I wanted to make about introductions was that, and looking for financing, is that usually entrepreneurs think of financing as the first thing, as opposed to kind of the end of the process. I think it really, you should, it's probably fair to say that you are not as prepared with respect to having an investable opportunity as you think you are. And that the place to start isn't going out looking for an investor. The place to start is getting connected with a network of advisors and supporters that will help you get to the point where you actually do have an investable opportunity. And I think what you'll find is, by the time you actually have an investable opportunity, you will have enough network where you'll have introductions to appropriate investors.
So Brad, for you, what is an investable opportunity? I know it's different for each person. There's a subjective element. But for an angel like yourself, what does it take to be an investable opportunity?
I think for me, the main thing is data. So I'm not interested in the snazzy presentation with all kinds of sizzle. I'm interested in, if you claim that there's a burning need, I want to see the data that shows that there's a burning need. If you claim that you have a strong value proposition, I want to see the data that backs up that statement. If you claim that you've got a business model that is sustainable and scalable, I want to see the data that proves that.
So the best way to prove to you that there's a market is customers, showing people willing to take a jump and take a leap. Is that the same for you, Gerard?
Absolutely, but I really like what Brad said about getting to know the investors beforehand. At the end of the day, you know, we tend to look for either a disruptive product, a product that disrupts the market, or we tend to look for a change or disruption in the delivery channel. But like I said earlier, we're looking for a value proposition. We're looking for how our members are going to add value. And when Brad spoke about particularly how individual, meeting, individual investors, engaging them, getting them involved from an advisory board or even a potential board of directors process, that's the, shall we call it, that's the courtship of the process. And those entrepreneurs that realize the value of that start realizing that when they go for investment, they become a warm introduction instead of a cold call.
So Pat, for you, if we're going to go with this courtship mating ritual metaphor, what does it take to get a date?
I'm actually going to start a little earlier, which is to say when you conceive your idea and your product, the first thing that you, or service, the first thing you need to do is actually talk to somebody in the industry to make sure it's well targeted. And I want to see that you have somebody who is an advisor who is in that industry. And it doesn't have to be a high-level employee, but often if you don't, the product is mistargeted. So if you're targeting the event management industry, you need to talk to event managers and find out what it is they're looking for. And it may not be new features, it may be ease of use or something you haven't really thought of. I would also suggest you need to find out what regulates your industry and what the various standards are, because increasingly we're in a regulated industry. So for example, I remember a company that pitched to a group that basically said they were going to create a cow-side mad cow disease. The only problem with that is anytime anybody has that type of an animal, you have to call the feds. The feds take the animal and they slaughter the whole herd. So they're not seeing it go. So it's not a really repeatable business activity. Someone who wanted to test in milk thiamine because they thought it was too low. Again, only the government tests things like that. So find out more about your industry. I would recommend that you go to the Founders Institute, because sometimes you can get some advice from people in the industry by giving them a little bit of equity. And they have some agreements that are on one of the agreement sharing.
So the Founders Institute is almost like an accelerator before you even have a startup.
That's right.
It's handled in over 100 cities around the world. You can find out information at foundersinstitute.org.
And they have some standardized agreements that say what stage of the company is and how much time should somebody be involved in investing in your company and how much equity should they get and what should they be doing to promote their company. Because you're not always going to get somebody involved until they know more. And if you're going to be using a lot of their time and advice, you need to provide them with a little bit of reward. And these aren't big amounts, they're like 0.5% in some instances. But it gets them committed to the company, and it creates a reasonable expectation between you and them as to make sense. But network to find somebody who knows about the industry you're targeting. That's the first thing. They often will know who some of your potential customers are. And your competitors could actually be customers. So a lot of times I find that people don't know their target market very well, or the demographic. An example I would give is in assistive technologies. A lot of medical companies try to overprice their products, and people who are paralyzed often have a family income of $20,000 and a lot of debts. They're not going to necessarily pay $5,000 for a prescription for a physiotherapy thing. And that is especially true, if not more so, in the US. We're pretty privileged in terms of our medical things. So those, do your homework first before you start talking to angel investors, because sometimes your first shot is your only shot.
So get some data, do your homework, get a warm introduction. Derek, what is something that a startup has to have before you would consider it an investable opportunity?
I mean, there's many ways to look at it depending on, you know, how you want to invest, of course. And what, Matt Golden from Golden Venture Partners, like his view, and I thought was, pretty insightful and clean and clear, was there's really three things. You're looking for a team that you can invest in, that you believe in, that has shown some ability, to get something done. Secondly, it's the market that they're in. How big is the market going to be? And third is really about how much traction they have in terms of customers or users, whatever that metric is, for
Team,
their
market,
business.
traction.
Yeah, and those are the three. So you don't have to have all three. I think you have to probably have at least two of the three to make it interesting. But I certainly look for, they have to show something. I'm not at the point where I would invest in a company that basically just has an idea. They have to at least show me, a prototype. If they can show me a prototype with a great team, that's one thing. If they can show me a prototype with traction, maybe they don't have the most experience, that's cool too. But I would say looking at two of the three of those things.
So we've heard team, traction, technology. I've heard management, magic, market. Bryce, for you, when we talk about management or team, what is it that you look for before you write a check?
Right. So on the management side, I actually wrote down, I'm only with notes up here. I don't know, maybe I did too much homework or something, but helps me collect my thoughts. On the management side, I wrote down a bunch of different words to describe kind of what we look for. And it starts with tenacity, so the absolute, complete, and utter focus on the idea. Track record is awesome if you can get it. The problem with track record is often those guys are hard to reinvest in because they've already got the network and they're on to round two, and you need to kind of interject into it, particularly if they've been successful. Their drive, financial literacy is very useful, not always in place and can be augmented potentially, but I love CEOs that are financially literate. I find
So
it
you're
nice.
talking about even understanding business models, financial projections.
Yes.
You don't want to see 5-year projections in crayon.
Yeah, we've passed on more deals because of a lack of understanding at the top level, addressable market, and then working their way down to customer, and then ultimately to customer acquisition, to churn, and all of that, and then ultimately to a market share that just makes no sense. So that funneled down to get to actually what we're all talking about, which is a customer acquired at a cost and can be maintained for a certain amount of time. A lot of guys fall apart on that analysis.
So Bryce is talking about top-down financial statements, bottom-up modeling, churn, cost of a customer acquisition. If any of these terms are foreign to you, check out a book by Steve Blank called The Startup Owner's Manual. Okay, because they're all bang on, and maybe we just don't always recognize it. Brad, what do you look for in management?
Well, first let me preface it that there are 1,000 things that need to go right in a startup, and any one of them can sink it. And so what investors will be going through is sort of searching through all the different aspects of the company, trying to make sure that there isn't a fatal flaw that's obvious, and that where there's weaknesses, that there's something that can be done to mitigate that. In a management team, one of the most important things is that it is in fact a team. I think probably one of the first ways for a startup to fail is to have the lone entrepreneur. Businesses, sort of at a very high level, need to have somebody who's very good at delivering whatever product or service the company is going to deliver. Somebody who's talented and passionate about selling and marketing that product or service, and then somebody who actually has some talent and passion around the financial management of the firm. And so a complete team is going to have those things covered. And if it's unlikely that you would find one person that is talented and passionate in all three of those areas. And oftentimes, young entrepreneurs, inexperienced entrepreneurs, get confused by some of the mythology around very high-profile entrepreneurs, like a Steve Jobs or Bill Gates, or reaching back, you know,
Michael
way
Jack.
back, Henry Ford and so forth. If you really look at what any of those people did, was they were in fact part of the team. I think when it comes to sort of some more up-to-date terminology, I know the 500 Startups guys talk about the huckster, the hacker, and the hipster. I think that it's just another way of reflecting that you need a complete team covering all the critical aspects of the business, so that you're not going to have some aspect of the business being done by somebody who doesn't have particular talent or passion about that area.
So if you want to Google something, I would recommend the term talent triangle, which refers to the domain knowledge, operational experience, and business acumen elements of a well-rounded team. Or you can call them the huckster, the hipster, and anything else. But the idea that all these things have to be in place and not outsourced is really important. But Gerard, you can't have a great team without the money to pay for them, and you can't pay for them without raising money, and if you don't have the talent, you can't raise the money. What about this catch-22 that young entrepreneurs always complain about? How does it play out in your mind?
Well, we look, or I personally look for some evidence that there is an understanding that you need to make some sacrifices at the early stage. You're going to need, you know, this concept of bootstrapping is more than just getting a less expensive office. It's more than getting using less pencils. It's really about understanding how you can push a business to at least a stage of validation without getting, call it invested capital. So I see models that are very successful where a company starts, they're looking to push a product forward, and what they will end up doing is doing some consulting. So they decide 50 cents of every consulting dollar goes back into the business, 50 cents of every dollar helps them operate, helps them live. I met 3 entrepreneurs, 3 guys out of Waterloo. They built an advertising-based model. They used rented servers, and they grew that company to $600,000 or $700,000 in revenue, sitting in Starbucks and one of the guys' mother's basement with a Wi-Fi. They still hadn't perfected what they wanted to do, and it was only then that they went out and looked for investment capital to bring that for a go-to-market strategy. Of course, the other common ways are, you know, work as a bartender from 4 o'clock in the afternoon till midnight, and you work at your business from 6 o'clock in the morning till 2 o'clock in the afternoon. But this creates the money to become the early investment to show that you're capable of understanding that you need to create value before you can sell that to an investor.
So if you're not investing in you, why should I invest in you? Brad, what do you think about that?
I just wanted to add 2 points. One is an anecdote about 3 guys starting a business. This is a real business, and they're doing quite well now. And the 3 of them decided that one was going to stay with the employer and support all 3 families, while the other 2 were full-time on the startup. And so just something else a team does to get going. The other thing
How did that story end? Were they all living in a camper? They didn't tell the end of the story, Brad.
They're actually, this is the Awake Chocolate Bar team that was on Dragon's Den.
Yeah.
And as far as I know, they got like over $1 million of orders now. They're doing really well. And I think the 3rd guy managed to leave his job, but I'm not 100% sure.
Derek, you accept.
But sorry, I have
Go
one
ahead,
more
you had
point,
2
if you don't
points.
mind. The other thing I wanted to mention along these lines is that, to me, one of the fine arts in entrepreneurship is figuring out creative ways to lower the risk without spending a lot of time and money. It's easy to show up and say, I got a great idea, give me $50,000. Professor Y says that that's all it costed to validate it. Okay, let's validate it. Well, no, that's not good enough. what are the real risks, and what are some creative ways to test those risks and lower that risk without spending quite so much money. I was sitting down with an entrepreneur, and the conversation started out with me asking, well, what does it take for you to get to these benchmarks that we said we'd make an investable? And he said, off the cuff, $50,000. And I said, okay, well, what are you going to do? And as we worked it back, I said, well, let's think about ways you could do that on $10,000. By the end of the conversation, he was talking about ways of doing it on less than $1,000. And to me, that's the real creativity. I mean, anybody can come up with a plan to spend a lot of money. The real art of entrepreneurship is figuring out how to lower risk and bring people into the story and build confidence on less money and less time. And don't sort of jump to your first idea about how to do something. Think about that as a start of the process of figuring out how to do it cheaper and faster.
Derek, you didn't raise money for Red Tech Deals, yet had a great success. Now you're on the other side of the table looking to make investments. What do you take from not having to raise money or surviving without angel money into looking at deals?
I think from my perspective, there's different types of businesses. Some businesses should raise money, and some businesses aren't necessarily set up to raise money. So to your point of the SME discussion, so for us at Red Flag Deals, we were focused on the Canadian marketplace, and really, by the time that people had started pinging us about investment, we really didn't need the money. We were profitable. We were doing well enough that it wouldn't really help us dramatically versus what we could invest from the funds being generated in the business. So I think the flexibility and the ability to basically work at your own pace and to build the company the way you see it is certainly the pro. Certainly if you have investment from the other side, there's opportunities that you just otherwise might not see. So there's relationships that you can get through your investors, there's mentorship that you can get through your investors. We got some of that through an advisory board, but that's not to say that if we didn't have third-party funds, that we wouldn't have seen tremendous opportunity in Australia, Europe, wherever it might be. So now that I'm on the investor side, I certainly look at this and say, how long does it look like it'll take for you to get to revenue? And you can work that back to say, what's your burn rate and how much money that you'll actually need? Is that achievable or not? But I typically look for companies that have a pretty clear and near-term ability to generate revenue. So I would prefer actually companies that are not like mine, which took years to generate a large enough user base and a large enough community to generate substantial advertising revenue. I would prefer to invest in companies that are generating revenue direct from customers. So obviously, a SaaS subscription-based model would be a lot of the companies I look at today, or some sort of company that can sell their product or service from a B2B side to sell to other businesses to help them make money.
Tricia, I want to ask you as we move from micro to macro about what it's like, what your opinion on angel investing in Ontario and where it will come. But I want to remind the audience that you're all welcome to participate. If you have a question, just raise your hand and our spry young man will run a microphone over to you. And why don't we start with the first question, all the way in the back. We're pointing to a... Sir, if you're going to raise your hand, you can't not... No. You're pointing to someone else?
Yes.
Oh, okay. You see it?
Sorry for the camera. My goodness, let's see. So I was having a discussion with one of the panelists earlier about some fears, and I'm concerned, trying to figure out whether or not I'm crazy. And I was hoping we could put it...
I can tell you right now you are.
Thank you. Well, we've solved that. But my name's Colin, and I'm trying to build an information security marketplace, so the eBay for hackers code. And I'm very proud to be Canadian, as I'm sure a lot of people here are. My family moved here from Africa many years ago. But I'm concerned that this might not be the best place for a tech founder. And I really want to stay here. I want to build my business here. I want to find co-founders here and mentors here and investors here. But
the question is, Canada good to be a startup founder? What's the
yeah, I mean, specifically, I look at Co-Founders Lab, which is a big index of people looking to build companies. And if you compare the people on there in the States, they have MIT educations, they worked at eBay and Facebook and Google. And you look at the ones in Toronto, and there's few and far between. There's not the same level of expertise. Or if you look at the top-tier accelerators over there, we don't have anything like 500 Startups or YC here yet, where they're fledgling. They're in development, but no one has that level of success. So please help me stay here, feel good about Toronto, and building a company here.
See, I appreciate your patriotism, but how about gun laws?
I would actually
How about quality of life? How about no Republican Party? I mean, we really have to deal with this. Let's turn it to a bigger question. On a national level, everyone wants to talk about India and China. They want to talk about the tiger, the dragon. What about the Wolverine? What about the Canadian startup scene? What is it really like out there? Is it all what's being proposed, that there's better places elsewhere, or is this a good place to build? Bryce?
Yeah, sure.
The Wolverine, is that a Canadian mascot that I missed? I thought it was the beaver.
But the beaver's not really a good metaphor for successful startups.
Okay, so here's, well,
Wolverine's small claws.
I'll hit this a few different ways. So I don't think anyone's going to argue that the U.S. Valley and New York and some of the hubs are very, very high-scale areas, and and have a lot of quality there, massive quantity of deal flow, and the educational institutions there are pretty incredible. However, if I look at Toronto, and I look at Toronto and Waterloo and Vancouver and Calgary, Montreal over the last, call it 15 to 20, and both education, institution evolve, the ecosystem of successful tech companies, the Constellations, the RIMS, the OpenText, the guys that have gotten large, Cognos and so on, and back to that accelerated concept, and you can't turn around without a new entrepreneurial organization. It becomes very hard on my side to figure out who the hell to join and who to work with. There is a massive swell right now, in my view, in Canada, in Toronto, and in Waterloo, and some of these other bigger centers of entrepreneurialism. So I personally think that I could spend my entire career investing here, and I could never ever deploy all the capital that I would want to deploy. So. I couldn't find enough deals. Sorry, I could have an unlimited amount of capital. I couldn't, what am I trying to say here?
I think you're saying there's free money in the parking lot, meet you there later on.
What I'm trying to say is I wouldn't have to go outside of probably even Toronto, but Canada for sure, to find deal flow and be very, very satisfied to multi-$100 million of scale. You look at what Ruffalo's doing over at Omers. You look at some of these other larger venture thinkers now, Sam Dubach doing the federal government thing, $400 million coming out of that. There's a lot of money coming down, and there's reasons why that is. That's point one. Point two is, I think I would recommend talking to guys like my partner, Tony Lacavera, and I at Global Ivan Wind, and talk about entrepreneurialism. Talk about Dan Shimmerman at Verisent, a good friend of mine. I was first round. He sold to IBM last year. Talk to just the litany of guys that have, over the last 3, 4, 5, 10 years, successfully invested, exited, or are still in their deals, and are staying in Toronto. Maybe they travel to the Valley, maybe they do some raises with Silicon Valley VCs, but we can absolutely compete here, and the ecosystem to me is getting better by the week.
We have one more question from the audience.
I would also suggest it's the entrepreneurs that make the ecosystem, not the ecosystem that always makes the entrepreneurs. So the beauty of ICT is you can be anywhere, and your co-founders can be anywhere. There are lots of businesses where the founders are in different countries these days.
Another question from the floor, sir.
Hi, my name is Ivan Millen. I'm trying to develop some new technology, and I would like to know a very simple question. If you, as an angel investor, take $1, how much do you want it back? In how long time do you want it back that you would be happy? Is there any formula like
So
that?
other than lots and faster.
I know that, but I want the direct
so
formula.
let's talk mathematically. Gerard, what's too little, too long? 10 years, 10%?
So the first of all is the thinking is if it's much beyond 7 years, it looks like a lifestyle business. However, when I first entered this space about 3 or 4 years ago, there was always a school of thought I was looking to exit between 3 and 5 years. You exit a startup with a more than a 2 times multiple, and in that period of time, you've probably had a lottery ticket, and it is in the same category of winning the lottery. I think the expectation today is probably somewhere in that 5 to 8 year range, and the multiples, the expected multiples on a single deal are still north of 10 times invested capital. What's the average? The average over a total portfolio is something like 2 to 3 times. So the math that I think was talked about earlier, one of your deals is a home run, slammed it out of the park. Another 1 to 2 deals, you get your money back. Another 1 or 2, it sounds like it's at the nursing station, and the other 3 or 4 have gone into vaporware. And that generally gives you what I've always gone at this space when doing is try to at least decrease those 2 or 3 that are never going to make it. In other words, take them off the table, so therefore we're only dealing, instead of 1 or 2 being successful of 10, we're doing 1 or 2 being successful of 6 or 7 or something of that nature.
So while on an individual deal you might have to get 10 times back, you have to account for all the dead and almost dead zombies in your portfolio. So that may mean that you only made 2 or 3 times overall what you spent. But how do you look at portfolio management, Brad? And how do you look at the zombies, the dogs, the winners, and choosing which you get behind?
Well, I wanted to make the point that for the most part what we've been talking about are sort of swing for the fences, high return, high risk kind of startups. Not every startup business is that high risk. Not every angel investment is close to that end of the spectrum. And one of the companies I'm most involved with right now, I would say isn't that sort of high risk swing for the fences. They have a relatively simple business model, are going to be able to scale reasonably quickly, but not through the roof kind of fast. But it's just not that high risk, but the returns are good. It's probably not going to be, 10 times in 5 years or something like that. So it really is a balance of risk and return, and fitting the investment opportunity to the investor. If we're talking about those significant sort of swing for the fences kind of high growth, high risk, high return startups, yeah, I think that if you can't table a plan that shows how in some reasonable projected near-term future there's going to be the potential of a 10 times return with some credible evidence behind it, yeah, it's not, you're going to have trouble getting interest because they really are so high risk. And I know you will all feel like this isn't that high risk, but all you have to do is look around at all your friends' startups and look at the history of startups to convince yourself that on sort of an aggregate basis, yeah, it is a very high risk kind of venture. So when you get people putting their, as Professor Wise puts it, their hard-earned life savings into your venture, you really are, you really do have to take that with some seriousness and recognize that you have to do your best to produce an extraordinary return for them to make any money at all.
About that time frame that Gerard was talking about. In B2C, which is a very scary sector, or a scary area to invest generally, just to give you an example, we've spent about $100 million in advertising at Wind. The consumer can be a very funny critter. We look for 10 to 100 times on consumer, and unless it is a more advanced type of deal, and we look for that in the same time frame.
Derek, risk reward, but let's also add in there traction. How far along is too far along? How soon is too soon?
I mean, how far along is too far along? I mean, really, I think it's a valuation question in a sense. I mean, I would love to see companies that are really far along, but come cheap. But that doesn't happen, and it shouldn't happen if the market's efficient. So as much traction as possible is obviously great, and too early for me is without prototype. And I would love to see some sort of revenue or customers, or beta customers, or usage. If it's consumer, then I think it's more along the lines of usage. How often are they, using the application? If it's an app, how often do they go back to the site, for instance? How many users do you have? Time spent on site. Those probably are some of the key metrics you would look for. I agree. I think consumer's a tough space. Consumer, you really need these huge, ginormous home runs. So as an angel, I play more in the B2B space, which is sort of funny because my site was a consumer site.
So Derek's raised the specter of valuation, and I want to bring that up. So valuation is, I'll give you 10% for $10,000, and that sort of thing. Other than Dragon's Den, it's not that straightforward in the opening conversation. The other thing I notice is that many people don't realize that valuation is set by the buyer, not the seller. And that buyer has other opportunities to invest. Where these may be your only 4 angels, you are certainly not their only 100 entrepreneurs. So how do you approach valuation, Brad?
I think this is probably the topic that I find entrepreneurs are most, shall we say, confused or
Obsessed, fixated.
Yeah. That it's all about demonstrating how you can deliver a return. So you start with what is it you can offer to the investor in terms of a return, and that pretty much says what your valuation up front is going to be.
Process it. If you show them what they're going to make on the back end, you have to know what they came in on the front end. If they want to make 10 times the return, and they gave you $10 million, you can do the math. Derek, how does that sit with your way of approaching valuations?
No, I think, no, that's absolutely right. I think to your point earlier in your presentation, my view is it's a long game. So a lot of the entrepreneurs out there are probably going to want to start, second and third companies. If your company has a life of, say, 7 years before you exit, that means you probably have lots of opportunities to do additional companies. So I think it's important that anybody who invests in you, they come out a winner. And even if they're not a 10 times winner, if they're a 2 times winner and you can get that deal done, then that gives you lots more opportunities down the road. So I think it's important that you don't set the valuation too high. It has to be something that is truly achievable. And of course, the temptation is you want to give away less of the company, so setting the valuation higher and being able to raise at that level. But ultimately, if you have a long-term view, I think you just want to make sure that your investors get their payday, and then you'll have plenty more opportunities down the road.
Mr. Buckley, how do you address valuation, sir?
First of all, the research is out there, which really talks to what Brad is saying. The average exit by Google, 95% of their purchases are for 25 to 35 million. They're somewhere in the 6 to 8 year range. You back it off, then you come up with a valuation that runs somewhere between $1.5 million and $2.5 million. ARI, Angel Research Institute, which is part of the Angel Capital Association of the U.S., does some anecdotal research among its various groups in the United States. The average range of valuation runs somewhere between 1.6, 1.7 million and 2.5, 2.8 million. Those are the numbers that everybody sees. That's where the research is. There's at least 3. I've actually prototyped my own as well, a method of evaluating pre-revenue companies. And when you look across these, there are the methods that are referred to as, the David Burkus method. There's the venture capital method. Bill Payne has ones. So these are methods that are well written about by ARI. But the bigger question for us as an angel group is we want to be able to add value. So if we're going to add value, we look to be able to do 25 to 35% of a deal. So we are able to go in with a reasonable ownership position, but the entrepreneur is incented to grow that company to the next level. It's also not a valuation level or an ownership position that if we're punitive to the next round. In addition to that, we are ensuring the entrepreneur maintains control of the business. As much as I like to invest in your business, and I don't know what, making a widget or making a whatever, I don't want to wake up in 6 months' time being the guy that has to run that business.
So there's an interesting trade-off going on here. As an investor, I don't want to dilute you to the point where you don't want to go to work. I don't want to own so much that I have to go to work for you. But there's still a sweet spot. So in my case, I don't remember a deal I've done under 20 points, and I don't remember a deal I would take more than 40 points. I mean, it doesn't matter. I would rather lower the amount of capital I'm investing and the valuation than try to give them too much and own too much. Pat, what's your experience when it comes to valuation?
Well, I actually would suggest that there are some resources out there that are quite useful. And if you walk into an angel investor and you say, I'm 10 times revenue, a lot of people won't talk to you, they'll just walk, because there's no point in talking to someone if the valuation is too far apart. So something that I recommend to people who are in ICT is there's a company called Decision Resources. Their website is Decision Resources INT for international. And they look at the public markets and they also list deals. So quarterly they come out with a report. It's a US M&A shop in that field. And what they do is they break the IT industry down in terms of public companies into 10 different industries, and it plots what the basis in each of those segments, whether it's multiple of revenue, whether it's multiple of earnings, or how that works. And you can see it graphed. You can also see what deals were done in that industry. So that should give you a better idea of how to price your things and where you're in. So you want to be 10 times revenue because Radian 6 was 10 times revenue, and you're not the first one there, you're probably not pricing it, and that's pretty typical. So the other thing I would suggest in terms of, and that's true of anything, there's a ton of public information there. All you have to do is go to your brokerage, it's all online, whether it's Canadian or US. And if you're looking for marketing information, by the way, the fact that the US companies have to disclose a huge amount of information about their business model is a really good way of finding out information. Because they will tell you who all the competitors are, they will tell you what the competing technology is, and they'll tell you what the market size and the demographics of whatever it is they're targeting. So SEC filings are great, and you can get them with your internet, and they're typically listed.
The Securities Exchange Commission.
Yes, Securities and Exchange Commission in the U.S.
Bryce, I want you to answer us honestly, and I know you will. I love to teach my students.
Can I make one last point? And private companies, by the way, generally sell at a discount to what public valuations are to deal with the liquidity. And the discount is often, if the accounting firms are looking at it, such as Deloitte, it's often 13 to 50%, because where are they going to sell the business? So, you know, if you price yourself out, you just won't get engagement. So, from a negotiating strategy, to be the first person to name a price is probably a bad thing.
So I think what Pat is saying, that if they ask you before you even talked, you know, what's the valuation, and you say 100 million, they're never going to even have a conversation. But you're not suggesting that you set price. You're suggesting that you have to have a reasonable understanding going in.
I think that the more people know about what a reasonable valuation is for your company at your stage, or for what that industry valuation is, because it speaks to exit, you know, that is, you're more likely to come to a meeting of the minds.
But Bryce, isn't it all full of crap? Isn't all these formulas and driven a great starting point, but in the end it's a negotiation between two adults, and you have to find a price that someone's willing to pay for it, as much as finding comparable?
You know what, it's a great point. All of these points are awesome that the panel's making, but what I find is that in the stage of investment I think that we're generally talking about, so you don't have the meat of public comparables that are actually relevant from a financial metrics standpoint and so on. What ends up happening is you bring a business plan in, it's got spectacular growth, you're doing 100 million in revenue in 5 years, and you work back to a valuation, you're going to haircut down your valuation significantly, and then you're going to get haircutted further and further, and then it kind of is hard to make much comparable sense of it. And what I find it ends up being in this stage of investment is, you know, we're talking about, I don't know, $1.5 to $10 million, maybe that's a little bit high even. We're talking $1.5 to $5 million valuations. I have sat in rooms with my business partners where we said, do we care actually if it was the 1.5 or the 5? Because this thing's either a 0 or it's $100 million. So it ultimately partly comes down to what's fair for both sides and what's fair to keep that entrepreneur motivated and rolling, and how good they can negotiate and how they're presenting and so on. So I think it is very important to walk in heavy on the numbers. I'm a big fan of financial literacy, as I've already indicated. I love guys that come in with a plan. They do work it back, kind of more to Brad's point, what is the return? It's all calculated and so on. But ultimately, it does come down to If I'm the investor and I quite like the concept, I'll probably lend to a higher value versus the guy who doesn't like it or likes it less, and kind of that meeting of the minds.
Brad, Roger Wilson, a venture capitalist from the BDC, is famous for saying, I'll let entrepreneurs set any valuation they want as long as I can set every other term in the term sheet. Is there more to term sheets than just valuation?
Yeah, for sure. That's and it is absolutely true that there are so many other things going on in a term sheet that matter. Probably the one that you'll run up against first is if you're doing a significant angel deal, something of the order of like probably $300,000, $500,000 or up. They're going to be looking for what are known as preferred shares, and the preference that those shares get over common shares is typically a sort of a first in line for whatever proceeds come out of some liquidation event. So for instance, if you get acquired, the preferred shares will get some first crack at the proceeds from that sale. It's not unusual to see 1, 1.5, maybe even 2 times liquidation preferences in the term sheet. And that's an example of something that protects the investor on the downside such that perhaps they're willing to take a little less of the upside.
If you've never heard of ratchets and liquidation preferences, if you don't know your pref shares from your personal shares, I would recommend Brad Feld's Venture Deals. Brad Feld is a famous VC from the States, and he wrote a book on how to be smarter than your lawyer. And as a former lawyer, I can definitely tell you who he is.
Can I throw a point out?
Please throw as many as you like.
Yeah, from my side, just following on what Brad said, we, coming in early, often common, maybe sometimes incorrect, but often common, we are extraordinarily sensitive to being very careful with what the financing path will look like for our company. So we look at pro ratas in future rounds as pretty important to us. We never want to block the entrepreneur's ability to raise money and so on, but we are acutely sensitive to not getting crushed out by VCs, and that is an important component to us to protect. And we try to work carefully with the entrepreneur to do that. Where we, like, again, back to liquidity preferences and so on, we really like to manage that as best we can.
So Bryce, when you talk about that, the phrase reasonable not right comes to mind. No one can predict 5-year revenues, but they can know that 100 salespeople selling 100 a day will never get to $1 billion. They can see the layout. So what do you look for in these future plans if it's all made up?
Yeah, so if we're talking about like trying to evaluate the business
or what
plan,
future revenue I'll need, or what future financing I'll need.
Yeah, I mean, look, it's back to, we'll start with the concept. Do we like the industry? Is there something unique about it? What is the addressable market? Although, I'll give you an example of, sometimes examples might be easier. So, this is how wildly different something can go, and everyone will have stories about this, but I like telling them. So, a year and a half ago or less, I was introduced to a gentleman by the name of Isaac Rychik, who started a company called Keek. I don't know if anyone in this room has heard of Keek. Keek.com. Remember that one. Isaac came in, pitched a partner and I on a wearable camera. So you'd have a camera on your lapel, small little piece of hardware. You'd see something in the world that was of interest to you. You'd push a button. It would take up to a 36-second video clip. If you hit a Wi-Fi connect, and it would upload to the cloud, and then you could go and view it on a website. We didn't like the concept. His projections were insane. And like it was a hardware business that would have, like it was crazy, hundreds upon hundreds of millions of dollars, and all these things would have been sold in a consumer product that had absolutely no proof. But we liked the guy a lot. He was a wily 63-year-old who acted like he was 25, and we had a couple of successes, so we liked him. We liked the introducer too. So we invested in him, first round, early valuation, and within a few months he threw that concept out, and then he moved it to a social video app, and iOS, Android, and so on, and the rest is history. I mean, he's at 25 million registered. He's actually approaching Pinterest level of engagement. So the point to that is we do, on B2C in particular, take all of that stuff with a very big grain of salt. we have to like, believe, and see something that's very interesting in the concept, and then it becomes that negotiation that you said. And again, as many basic protections as you can get in the prefs. On the B2B side, often a little bit more meaty. Let's talk about the addressable market, who are the competitors, how big is it, what is Gartner talking about in this space, and let's work our way down. And then we'll get into a more tangible discussion. How much money do you need to raise, blah, blah, blah.
My colleague from the Ryerson Angel Network, Jared. You had your hand up, you wanted to add
Yeah,
something.
so I just wanted to add, like I think, you know, sometimes we maybe think too much about the valuation piece, and one of the ways to sort of short circuit the process, at least for the near term, would be to do a convertible note, and convertible notes are just easier to execute, and it puts, you know, typically a cap on the deal, and the cap might be higher than what you might get if you were just raising, you know, at that valuation straight, because they have potential that, you know, if there is a future round, that the number is lower and they still get a discount to the cap. So I think it's a great way that removes a lot of the friction on both sides to really get up and running without having to figure out, you know, all these individual terms and nuances of a full-on term sheet.
Isn't there a debate around that, sort of the capped versus uncapped, and what you're saying is better for the investors?
I would not do uncapped. That's my personal preference.
But there is a debate. There's also a debate over whether venture debt is really venture or debt. There's a debate over convertible versus common, shareholders term. There's a debate whether or not a shareholders agreement is all you need, or do you need 51%. So there's lots of opportunities to interpret this, but you're saying for you there's a preference path. Brad?
I think that one place where convertible debt really makes a lot of sense is when a company is really still in the discovery phase of trying to uncover their business model and they're not really ready to scale. Particularly in the web mobile space, it doesn't make any sense to spend 3 to 6 months raising some pref share deal when validating the business model should only be taking like 3 months. So I think it's really important in that discovery phase to keep the management, the team focused on uncovering that scalable, sustainable business model and hitting product market fit. And the best way to avoid having financing distract them too much off of that discovery process is to do something that's quick and lean. And there's nothing quicker and leaner than a convertible debt note. For the most part, you probably don't even need a lawyer if you're doing a convertible debt note. I mean, they're just relatively simple things to read, and particularly if they're coming from sort of some reasonably well-known source. Yeah, you can probably get it done very quickly and very low overhead.
Matching the stage of the risk to the investor's appetite. We're going to start to wrap up, and I'm going to open the floor again to questions. I'm going to ask all of our panelists to contemplate 1 or 2 minutes of advice they wish they got before they started their entrepreneurial journey, and you wish to impart our audience. So while they're thinking about that 1 minute of advice, we have another question or two from the floor. If we can get a microphone over to the young lady from Ryerson, we'll not play favorites too much.
Thanks, John. I'd like to ask you about angel networks. Can you pitch to several angel networks at the same time, or is that a faux pas? And also I'm wondering, how often do your members actually invest? Are they very cautious, or will they get into many deals?
Trisha?
It varies a lot. In terms of statistics, in the funded groups, there are about a little under 700 members right now. In terms of the actual numbers, I think this last quarter, and we also have clubs, and I think the last quarter, both groups invested about 8 million, somewhere around there. But there were a lot of people that co-invest with them that aren't necessarily members of the group in the same rounds. So that typically doubles the amount of money that ends up going. Cumulatively, I guess about 130 million has been leveraged into 113 companies since 2007. So, and created about 1,200 jobs. So we think that that's a good thing.
Gerard, from the Maple Leaf Angels perspective, Is it a very active group? Do you often double dip? Would you be offended if they went to the Ryerson Angel Network first? How do they play together?
So first of all, you got to realize only 6.5% of business plans that are seen across the country get invested. Second is, at a group like Maple Leaf, we would often encourage to go through a process with one particular group, especially if it's going to come out with a positive outcome, because then the introduction to the second and third group will be a warm introduction and will become from like-minded individuals, and you're actually getting one of the angels from the group that you brought the deal successfully to as the warm introduction to the other group. We actually actively discuss syndication. We actually refer to it. So among the 4 or 5 groups, especially in Southern Ontario, Maple Leaf, York, G10, Angel One, there is an active dialogue. I know the executive director and
Mr. Ryerson Angels.
Oh, Ryerson, sorry.
Thank you very much.
I know the executive director and the chairman of the board of every one of those organizations, and I can pick up the phone and have a conversation with them within seconds.
So the short answer is no, it's welcome. And if you don't talk to the other groups, we will.
And we've had about 2,000 submissions to the group, so a lot of those are probably double counting.
We also share a platform to share deals that can share due diligence documents, that can make it efficient. It's easier for me, if I'm looking for one more angel to backfill $50,000, to reach out to another angel group, because they've already been pre-screened, pre-cleared, they have a relationship. There's another question in the very back, though. I want to get to that. Sorry, Petra. Go ahead, go ahead.
Hi, my name is Winston. I have a question about the future of investing, and will it be easier for entrepreneurs to invest money, get money in the future?
So we talked a little bit about all these changes, these angel lists, these disruptions. What do you think the future is at seed investing, Brad?
Sorry, one thing that we haven't talked about is crowdfunding for equity. As many of you may know, the OSC, the Ontario Securities Commission, has floated a proposal around crowdfunding for equity investment. And they're looking for comments. The comment period's open until April 8th. I would encourage all of you to submit a letter response to them. You can email it in, just saying that, yes, you see this as a good thing for entrepreneurs, a good thing for investors, a good thing for Ontario. And that will be one place where a lot of these ideas can get the investment to at least prove out the initial traction that can then give you the data that's going to make you investable from some of these other sources.
Other questions from the floor?
Any more questions?
One in the front there.
So what have been some of the best exits for you guys that have invested? I'm more interested in the enterprise space, but feel free to talk about any one of those.
So which one gave you a bathtub full of money? Which one do you still dream late at night about?
I'm still in the space. I've only been in the space 3 or 4 years, so I haven't had that happen yet.
I'm in a similar situation, but I did invest in Year One Labs, and they had one company called Local Mine that was sold to Airbnb, so I'm hopeful on that one.
One was at 50 times, but it was much bigger, and I didn't sell half when it was much bigger, so that happens.
I would say we have there's 2 to talk about. One is the Global Live Wind story, which is complicated ins and outs of equity and so on, as you would expect, including some recent stuff that we've done. That's a big scale deal that's not really comparable. On the smaller scale, actually the deal that we have made the highest return on is when we started our investing career. We actually started buying US shells and doing reverse mergers into them back in the late 90s. And we did an oil and gas deal out of Alberta, and it was a monstrous home run. So, hundreds of times.
Congratulations, Brad.
I'm still waiting for my monster home run. But probably DNA Genotech in Ottawa would probably be the best return for me so far in terms of, like, strictly speaking, angel investing. And oddly enough, it's not a space I knew much about, but I did know the people who were early involved. And so that was kind of, as some of us have talked about, more of a people-driven investment than the specific opportunity.
And for me, it was Transgaming, which invented a way to play games on different consoles without recoding them. Sort of like when you watch Spider-Man in France, they don't fire the actor and hire Gerard Depardieu. They just subtitle it. They found a way to digitally subtitle it so Xbox games play on your PlayStation. And that was just a brilliant home run. I want to turn to our panelists who've been absolutely amazing and honest with their answers and leave us with a word or two of wisdom. And I'm going to start with...
There's one question.
There's one more question? Okay, yeah, finish on time.
We've heard a lot of discussion about management team being important, track record being important, but I've also heard a lot of comments from, especially out of the States, out of the Silicon Valley, where people that have tried it and failed, but learned from their expertise in the failure process, have grown to be better entrepreneurs for their next venture. Would you guys leave any thoughts in terms of whether a failure is an X for you or a plus?
So in Canada, in the US, if you fail 3 or 4 times, they say you're waiting to succeed. In Canada, if you fail 2 or 3 times, they say, welcome to the government. How do you look at failures? Would you rather fund someone who's failed a recent startup or hasn't had that experience? Bryce?
We would be very neutral. So if someone's failed, that is, hey, you had an experience, let's look at your current concept, talk us through the failure a little bit, and if we can get our heads around it, we're ready to roll again. So no issue. In fact, we're talking to a guy right now that is in that position, and we quite like his new concept.
Derek?
I think it's a pro versus somebody who's never tried before. So that's the way I look at it. Obviously, it's better if they had a success, but if they tried and had a failure and are willing to try again, that's cool. That's a pro. If they've had lots and lots and lots of failures, then that's not so cool. But if they failed a couple times, that's cool.
Brad, does it have to do with what type of failure? Like if it's embezzlement, maybe you wouldn't do it. But if it's a third party, like Google invented a similar product, you would. Are there some failures better than others?
Well, actually, they might be a perfect fit for our embezzlement fund. For me, it isn't the data point of a failure, to your leading question. It's more the story around that data point. What did they learn? What are they going to do different? And where did they, when they have a failure, it isn't typically failure across the board. Where did they have some success in all of that? And if in that, through that discussion, you can find evidence of a track record of the kind of skills and experience that are likely to contribute to success in this next venture, then it's a positive.
It's a great way to put it. Other questions? Then moving to concluding remarks, I will turn and ask Gerard to share his words of wisdom.
This space has a lot of activity. This space has a lot of activity in it. There's a lot of people that are socializing a business. It's not necessarily real. People often ask, should I start with a product? Should I start with an idea? I actually gave this advice to somebody last evening, and I believe you need to put as much or more energy into making sure you got the right team, and I am of the belief that the right team will be about the execution and will find the right ideas than the reverse. You've heard the adage that a bad idea with a great team is much better than a great idea with a bad team.
Patricia.
It's not always about, it's about supporting the business, it's about growing the business, but not all businesses are going to take off immediately. Sometimes you just have to work at it, and I would recommend the book Blueprint to $1 Billion, which studied quite a lot of successful public companies and discovered that many of them took 5 to 10 years before they grew at a very high rate. So from that point of view, it's get your foundations firm, run before you can walk. Keep in mind, if you're not sure, much the same way that many people go about bootstrapping their activity, there certainly is a study that said that some of the most successful entrepreneurs are those who are coming out of an industry. They know how it works. They know what the technology is in the industry. They probably, work in technical sales somewhere in an industry if you want to understand it. They have connections, and they get their best ideas for their new products because they know exactly what the industry is lacking and how to target it. So, there are many ways of coming to a business, and it doesn't necessarily have to be right out of university. I haven't actually run into a lot of entrepreneurs that that have failed. I've run into a lot more people who are starting first. The other thing I would suggest is be coachable. In other words, a lot of times people fail because they didn't listen to the people who actually had an investment in them, and that is kind of a fatal flaw. For those of you who are pitching for business contests, don't oversell, because it speaks to credibility and integrity. And that type of thing is definitely a kiss of death when it comes to if an investor feels as if they can't trust you to do what you do. So, under promise and over deliver. Those are the things that, there's so many of them are platitudes, but they're relevant all the same.
Don't call them customers if they're not paying you. Okay, Derek, your advice.
So it was mentioned before, so I think having some sort of advisory board or people who have gone through the process or are familiar with the field is one of the key things that we certainly look for when I do my investments. So just the ability to go out there and wrangle people and convince them that you're worth spending time with, even if it's not a financial relationship per se. And sometimes it is not. So I actually had the privilege of having a really fantastic advisory board at Red Flag Deals, and one of the guys who was on my advisory board, Chris Carter, then started up a firm called Kinetic Cafe. And one of the things I've really learned from him, as we've sort of done some startup deals as well, is to look for investors that could actually be potential customers. So really trying to have it both ways. So trying to convince them that this would be a great product for them to use, and then getting them to put in some money as well, because that often speaks to them potentially being a strategic investor, and it also speaks very highly of your ability to go and find other investors that they can see, there's a client investor on board as well.
Bryce.
Quickly, three recommendations. Number one is the ability, and you, the good doctor, hit this earlier, bootstrapping now is like it's never been before. Amazon Web Services, all this cloud stuff, outsourced coding, ability to do these contract exchanges and so on are like nothing I've ever seen. So the fractions of dollars it takes now to go from concept to at least prototype and live on the app stores and so on to see where they go is unparalleled. If you are a youngster and you are thinking about that corporate job, what happens is you take that corporate job, and I can't tell you how many guys of my vintage who are 40 years old who got caught in the corporate, they started making a salary and you become dependent on it, and it's very hard to leave and then try to bootstrap. Do it when you're coming out of school or shortly thereafter if you have the idea, and roll with it now. Take the risk now. What's another year or two? That's an extension of your university education. That's point one. Point two is with all these accelerators, advisors, IRAPs, Fed devs, shreds, and so on, there's tons of ways of extracting money out of our tax dollars. And from my perspective, it's as good a place that our tax dollars are being used as probably anything in the country. And then third, don't forget about sales. We are a country that builds good product. We've got good engineers in this country, and I've seen a lot of pitches where guys have come in and they got the next best mousetrap, but no practical way to sell it. Don't forget to equally pitch the sales strategy.
Great advice. Brad.
Actually, I'm glad you mentioned sales, because it's something that occurred to me earlier. In the list of the sources of funding, the best source of funding is customers. Sell them something. If the best business opportunities are the ones where customers are feeling tremendous pain and you're the only one that's offered them an aspirin, and when they're feeling that much pain, they will probably be willing to pay you just to get them on a path towards a solution, which means they'll probably pay up front for a product that you can deliver later. So definitely customers, I would say, are the number one, the best source of financing. The other thing is that it's easy to get too enamored with your idea. recognize that the norm, the usual thing, is that your idea is going to change. As you engage customers, you'll realize what they really want and how you can really meet their needs and what your business really needs to look like. So ideas are going to change. In fact, ideas are a dime a dozen. What I would encourage you as entrepreneurs to be focused on serving customers and looking for ways to serving customers, and recognize that it's in serving customers that you really understand where the business opportunities are. And if you find that you're not getting great traction on an idea in terms of people getting excited about it and wanting to join you in this great adventure on that idea, get a new idea. But the best way to get that new idea is start serving a customer someplace for something. And that's, to me, the sign, the hallmark of a true entrepreneur.
Just remember, Viagra wasn't used for what it was originally designed for. Find great solutions when you're looking for great problems to solve. One of the problems that we're solving here is that we're out of time. I want to thank the panel. They've been absolutely awesome. And I want to thank the Thai Institute for including all of us in our learning tonight. I'll turn it back over to our host, and thank you for the opportunity.